Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host. It is January 22nd, 2025, and it's great to be with you all today again. And kind of like last week, we've got a new guest here to introduce to all of you with some new different styles. Also kind of focused on the long-term investment strategies. It's Nancy Tengler. She is a CEO and CIO at Laffer Tengler Investments. Welcome to the show, Nancy.
Gosh, Justin, thanks so much for having me.
Yeah, so my pleasure. Ali Coram, of course, who hosts a lot of our things. She highly recommended you, and of course, I've seen you on CNBC and kind of doing the circuit. But it's great to talk to you and kind of pick your brain a little bit on what I think are some unique approaches to how you go through your stock selection and. Let's get into it. But first, okay. I want to just kind of get a little bit of your background, where you kind of came from and how you got into this business.
Oh boy. Well, I started the business, I'm sorry to report, in the mid-1980s. I was going to be a fighter pilot after college, and I applied, took all the tests because it seemed really exciting. And then one day I just woke up and said, "What are you doing? You're going to be in the military." And it was after I got my physical and had to do, exercises for them in your next to nothings. And I was like, this is not for me. Okay. So I joined a bank in Northern California and had a big trust department. And the gentleman I worked for had developed this approach, relative dividend yield, as a way to identify value. And so we were value investors, but everyone else was using low PEs and relative PEs. And we had to explain, we had to sell our process and the concept of value. And so it was it was a long process, but it became very popular.
Well, and hey, look, if it's one of those things where you're kind of doing what a lot of other people aren't doing, you get good at sales, right? Really knowing your stuff. So
that's right. Creative.
Yeah, learning how to sell ice to Eskimos, if you will. Well, that's awesome. So let's talk a little bit about some of the strategies that you've come up with, and in particular. Whenever I think of long-term investments, I almost always feel like you need to lean on earnings because nothing screams, long-term potential like the ability to grow your earnings, usually in a very stable way, in a very steady pace, but to such a degree that it's something that investors are going to get excited about. So what is your approach to kind of choosing your long-term investments?
Well, yeah, so you're dead right, Justin. I mean, certainly earnings matter. The problem is Wall Street isn't very good at estimating earnings. And so, every quarter we get about 2/3 of the companies reporting either above or below, and it's mostly above analyst estimates. And so and remember back then, this was like the days of fax machines, barely. And we'd get these research reports from New York. By the time we got them in San Francisco, they were out of date. So we were trying to find a way to look at companies that gave us insight into what management thought about future earnings growth. And in the large cap companies that we owned then, and in many cases own now, the management set the dividend as a portion of what they think is long-term sustainable earnings power. Mm-hmm. Recent great example is one of our largest holdings and kind of the poster child for our investing theme, Walmart. They, for a decade at least, just kind of raised the dividend 1% to 2% every quarter. And then every year, and then about 2 quarters ago, they raised it 11%. And that told us, we already owned it. It was already one of our favorite names, but it told us that management was very confident about the future and that earnings growth would accelerate. And indeed it has. So that's the information you get from using relative dividend yield. And we basically, anyone can graph it themselves at home. You take the historical yield and you graph it against the S&P 500. And what you come up with is these really clear periods of when the yield is high and a period of undervaluation, and when the yield declines, a period of overvaluation. So you can see in this chart, this is a fallen angel growth stock, which I will reveal in a few minutes, but you can see that.
Way to build the tension.
What's that?
Way to build a suspense.
Oh, yeah. Just hang on there. We'll be right back after the commercial. No, so what you see is that this stock got to a yield that was above 3%, and actually at the time above the 10-year Treasury yield. And it was considered before that a growth stock. So what relative yield told us was it was cheap, and then we had to do our fundamental work, which I know we'll be talking about later, to determine if it was a value trap or what we call a terminally cheap stock or not. And you can see that it was not. It's returned to growth, and that's reflected in the relative yield decelerating or declining into our sell range, which means the price of the stock's gone up dramatically.
Okay. So I was going to ask you about that because you mentioned the term terminally cheap. And a lot of times, of course, when you look at dividend yield, it's a ratio. And anyone that understands numbers, numerator over denominator, if you decrease the denominator, which in this case is the stock price, that's an easy way, get a cheaper stock or a stock that falls, it's going to make your dividend yield go up. So how do you kind of factor that in and make sure you're not just oh, I'm winning, on yield because I've got a stock that's falling apart?
You're absolutely right. All the research shows, Justin, that the top two deciles, and in particular the top decile in terms of yield, it is the segment of the market that underperforms over almost every time period. And the reason for that is exactly what you described. The company's having to pay investors a great deal to stay invested in the stock. Mm-hmm. We don't want to own those names. We're looking for fallen angel growth stocks whose yields have risen due to a temporary problem, and that's where the fundamental research comes in. And then we begin accumulating. And if we see any of the fundamental factors, falling apart, then we will exit. I think some of the best work we do for our clients is the companies we never bought in the first place because of our fundamental work, or the companies that we got out of. So think Intel, Zillow, CVS. Those were names that we owned at one point, and we saw that the model and the management teams were not up to the task, and we exited well before they crumbled.
Mm-hmm. So you're kind of avoiding the top decile, recognizing that they're kind of a cheap stock. So you kind of have your sweet spot. Where is your sweet spot?
The portfolio target is 50% above the S&P 500,
okay.
And we're there. We're yielding a little bit over 2%. But what's important is the dividend growth, the annualized dividend growth in the portfolio over the last 5 years has been 13%. So you can see we're buying companies that are growing the dividends. And if you take the income out of the portfolio, it's a hedge against inflation. It also this rapidly growing dividend provides protection in declining markets, and it also gives you the insight that I mentioned earlier. So we're in the sort of center decile. We will hold a stock until the yield gets well below 1%, but we won't buy it unless it has a yield above the S&P 500.
Now, let's talk a little bit about tech stocks, because of course when the 90s hit, it was almost like dividend yields. Who cares? We're all about growth. We need to put that money back into R&D and everything, and no one cared about dividend yields for a little bit. So, what did that do to your model?
Well, we didn't get invited to a lot of cocktail parties. Let me put it that way. My business partner at the time was speaking at one of the analyst societies. I think it was in New York, and he gave a speech about relative dividend yield. And this guy came up to him and said, "I don't believe in dividends." And my partner said, "Well, I didn't know this was a theology conference." It's like watching paint dry. I mean, back then you were excluded from tech stocks. Now many of the tech names that we own in this portfolio do pay dividends and are growing the dividends between 10 and 15%. So again, we're not striving for absolute yield. We're striving for the information we get and then the protection and the income producing properties of dividends. So I think that would really be the easiest way to explain it. We didn't own the tech names, most of the names at the end of the 90s. And so then we developed a second metric so we could participate in that very important space.
Okay, and this is an important one because, of course, what goes into earnings? Well, sales, revenues. So talk a little bit about this fundamental metric that you use and how you use it.
Yeah, well, I developed this as a valuation metric in the days of Enron, because what we knew is that earnings, there's all sorts of different earnings estimates. There's pro forma, there's GAAP, and you could drive a truck between the two of those. And so we wanted a more reliable metric, and so sales. And we figured if anybody manipulated sales, they would go to jail, just as
Yeah.
what happened with all the Enron kingpins. So
Mhm.
we wanted to we wanted to look at sales again in the same fashion, the stock sales history, expected sales, relative to its past and relative to the S&P 500. And you can see this is the same stock, by the way, of the previous chart. And you can see that there were very defined periods when the relative price to sales ratio is low. That's when you want to step in and at least ask the question, should we own this stock?
Mm-hmm. So you're seeing, is this the sales growth or the sales number, or what are you
No,
using?
it's the relative price to sales ratio. So
Okay.
when the stock is below the green line, that means you're paying a relatively small amount for, and especially based on the past, for a future unit of sales of this company. And so
Mm-hmm.
the chart, I'll reveal, both of those metrics are Apple.
Okay.
And the time period was about 210, 212 when we were accumulating it.
Mm-hmm.
And the both valuation metrics confirmed that the stock was cheap. And so we
Mm-hmm.
love when that happens.
Right. And it also goes to show you that, a lot of these tech names, they did change their tune, right?
Yeah.
Whereas dividends didn't matter for a while. All of a sudden, you started seeing more tech names, Microsoft, Amazon, oh yeah, let's start doing a yield, a dividend.
Well, I wish Amazon,
Oh,
Google for
I'm
sure,
sorry. I was
and
thinking of Google,
Meta.
Alphabet.
Yeah,
Yeah.
Google and Meta.
Alphabet. Yeah. And Meta. So, with these two metrics, this seems like a good start, because again, with the
Right.
dividend, you're almost getting that analyst opinion, but more accurate. And then, of
Mhm.
course, the sales, which is, as you said, it's not really something you can fudge there.
Right.
So, what else do you kind of add on to your approach here?
So these charts get a stock onto on our approved list, is what we call it, buy list, what other people call it, shopping list, some people
Mhm.
call it, and then we do the fundamental work. So we have a proprietary fundamental factor model. It's 12 factors, 3 are qualitative and 9 are quantitative, and we go through there they are. The company has to pass a majority of those factors before we will even consider buying it. And so this is one I sent you, as you know, on CrowdStrike, and we did
Mhm.
this analysis in February of 2024. You could argue we were early. We added the stock to our portfolios when they had the Delta, shut down airlines across the world,
Right.
bad blue screen day. We reassessed, and that's exactly what you're supposed to do. So, is this management team still competent? Is the franchise value and market growth going to continue? And what is the future catalyst for outperformance after this trying time? And we reconfirmed that the company still met our metrics, the management handled it as well as you could have, and we added to our positions. Sometimes we reassess the fundamentals and we exit in the names, for example, like I mentioned earlier.
Hmm. So that brings up a good point. What about the technical analysis? Does that factor in at all? I mean, CrowdStrike, got hit so hard on that day. And again, just as a reminder for folks, this was February 12th, 2024, where this analysis was done. So a little bit before that. But if you see something happen, an event, and it really affects the price in a big way, is there any kind of technical analysis or sell stops or something like that where you're managing your risk in that way?
Yeah, well, yes, we do pay attention to technicals because in the short term, the algorithms in the hedge funds drive the volatility. And so if you're paying attention to the technicals, you can get much better entry points. The
Hmm.
traditional value manager by instinct historically has said, oh, it went down, I'll buy more. And what I've learned over the 30 plus years I've been doing, okay, 40 years I've been doing this is that
I wasn't going to call you out on it.
sometimes you just need to, the opportunity cost is so big, you need to exit. And so we will do that. We don't have like a 25% stop loss in the portfolio, but we will reassess and then either add to the name or exit entirely. And that was our experience with CrowdStrike. We only had a modest entry level position, and so we added, and it's a bigger portion of our portfolio. And from the bottom, that was a great move. From where we bought it, the original shares, we're about even.
Hmm.
But we've bought a lot more since then, so this holding has done well for us,
Hmm.
despite the draconian problem.
Yeah, yeah. And so I also wanted to just kind of back up a little bit to share this graph that you shared with me, because this is CrowdStrike in terms of its relative price to sales ratio. So you kind of have these red lines that are identifying some targets. So how do you use this?
Yeah, so that bottom line should be green. I think it was just an oversight.
Okay.
I'm gonna go correct somebody after we're done. But you can see that based on its own history, even though it's not super long, CrowdStrike has been an expensive stock for sure. And even though on a PE multiple basis, it's expensive, if you look at it on relative price to sales ratio compared to its history, it is not. And so that was what gave us the courage to initiate and then to add more. And Palo Alto's our biggest holding in cyber, but this was a name we definitely wanted to own. So,
Well,
yeah.
now I'm looking at CrowdStrike and I'm looking at the dividend yield, and I'm seeing a big fat zero here.
Right.
So how does this, how do you use your 12 factors? How important is dividend yield? Are the 12 factors kind of treated equally, or can you fail some and it's okay? Or these are the non-starters? You failed this
Yeah.
and it's a no-go.
No, you got to pass a majority. So you can fail on the quantitative. You can fail 4 if need be. And you can see we had an NA for dividend coverage, but a fail on relative PE because the relative PE is high. But we run a growth strategy, and that's does not have any yield requirements, and that's where this stock is held. In our dividend growth strategy, our equity income is really the official name. You can tell we're not marketing people; we're just portfolio managers. That's where we own where we focus intensely on relative dividend yields. But we're always looking at both metrics to confirm what we're seeing from one. And if we get attractiveness on both, then that's important to us.
Yeah, absolutely. So let's switch gears a little bit because this is kind of given, I think, a good idea of your stock selection. And I love that you have it, broken down with, okay, here's our factors. Either it is or it isn't. It makes it kind of real easy to kind of see that in a dashboard kind of way. But let's also talk about portfolio construction. How heavy are you getting in terms of your position sizes? How much do you say we can own in any particular sector? What's kind of your portfolio construction methodology?
Yeah, that's a great question because that's where some of the art form comes in, I'd say. So we run very concentrated portfolios compared to rest of world. The growth and the dividend growth strategies have about 25 to 30 names. And then we have an even more concentrated strategy. It's our 12 best ideas. And it's an actual strategy that people are invested in. All of them have low turnover compared to the rest of the world, 25 to 35%. And the top performer over the last 5.5 years since we started the 12th best is the 12th best. The annualized return is something like 16.8 because what I know as a PM and what the research shows is that the optimal diversification is 12 names. And when you have more than that, if you're not willing to take meaningful positions, you're detracting from total return. Yeah. And so if you look at the dividend growth strategy, about the top 10 holdings represent almost 50%. And the same is true for our growth strategy. So we don't buy anything less than 2%. If we don't have that much conviction, we have no business being in the stock.
No, that makes a lot of sense. Again, as you said, yes, maybe you're getting yourself a little bit lower risk in terms of your standard deviation, but what you give up can be quite large as well. So being that concentrated, again, I have to just ask a little bit more that risk management side. When you're that concentrated, do you have to have different rules there for that level of concentration to make sure nothing gets out of doesn't take the portfolio down with it?
Yeah. We've had a few stinkers in there, but what's amazing is that even still, you can generate attractive returns. I know I've talked about this with you before, but if you look at the average hedge fund, they've returned 8 to 10% over the last decade, and we as active managers have done a lot better. And I think that's because we do have a long-term focus, and we are focused on the S&P as our our risk benchmark. So I didn't answer your question on sectors. We won't go more than 1.5 times at time of purchase any sector, and except if you're talking about materials and the really small ones, we'll go double those at least. But it's important to know what sectors do you want to be overweight in, and we're currently overweight technology, consumer discretionary, and industrials, and we're moving to an overweight in financials. But also, you have to overweight the better companies, and that's what we've been able to do to the benefit of our clients. And as active managers, we have been able to add value because we like some stocks better than others, or companies better than others.
Well, and for that sector, kind of weighting, you mentioned, we're seeing some movement in financials. Are you doing that as kind of a bottom-up approach? You're seeing the stocks that are meeting it, or is there some other metric that you're using to say, this sector is looking good for these reasons?
Yeah, well, so the stocks give you the information. Like, there's a lot of attractive names that are still reasonably valued. In 1990, in February, in 2020, going into February, we didn't know about COVID. We didn't know we were going to have the perfect storm bear market. But what we did know is we couldn't find many, if at all, cheap, high quality companies. So we put a hedge on all of our clients' portfolios. It was just simple. We bought puts against the SPY, but the companies will tell you information. And so we start there, but we also have a macro viewpoint. And our investing theme has been for 2 years, and it will continue, I imagine, for a number more. And it is old economy companies that are pivoting to the new technologies. That's why Walmart's the poster child. And then the suppliers of the picks and shovels, the infrastructure, the software, and that's many of the names that we'll talk about today that we think will continue to drive margin and earnings growth. And that's where we're focused. So that's our kind of macro theme that leads you into companies that are using the new technologies and then into overweights in certain sectors.
Mm-hmm. Yeah, and I mean, again, I like how with your 12-point fundamental analysis, as part of that, what are the catalysts? What are those? What are those new things, either in their industry or that this company is doing? Again, it just really jives with a lot of the things that we learned from the founder of Investors Business Daily, William O'Neill, in terms of finding that new element. So I want to kind of shift gears a little bit again to kind of see some of this in action. So maybe we could start with Tesla as an example, because this is a stock that you were owning at various times. And so I think January 2023 is what you shared with me, which is right down here at the lows. I think you were maybe 2 points or something off of the lows here for $100 stock, which isn't too bad. What did you see there? How was that not like trying to catch a falling knife?
Well, we were looking at the technicals, and that was important. I'd owned the stock before. We took a double in it, and then it felt just way too much like gambling. Remember when Elon was sleeping on the factory floor and his CFO was leaving? He had 3 board members, and they were mostly insiders. And then he went on the Joe Rogan podcast and smoked pot, and I was like, ah! So we had a double in the stock. We sold it, and we left about a 4-fold increase on the table. And that's when I learned a valuable lesson about him, his vision, his strategy, and his ability to execute. So when he was selling the stock to buy Twitter, and remember that was in the fall of 2022, and we were already in a bear market anyway, so everybody was in a pretty foul mood. And we looked at it began looking at it in January, and then we talked to the technicians that we like. We looked at the charts, and we picked it off at about 103. And then we had time to buy it. I mean, it went up pretty nicely, but we had some time to buy it. And then when it got to be in the mid 200s, we sold it. It might have been 230, 240. I don't remember exactly. And we trimmed it back. And then when it sold off again, we added back to our holdings. And during that period, what you were hearing from folks and I'm looking at my notes that I wrote at the time. What we were hearing was that, he was cutting prices because he couldn't sell cars. What we thought was he was cutting prices to drive his competitors out of business. But we never bought the story as just an EV car company model. I had the good fortune to go to the Megapack, which is the electric utility grade batteries to store renewable energy. I went to the factory in Lathrop, California, and I was so impressed with the earnings growth that even at that time, and it's been proven out since, that portion of the business, though small, is the fastest growing, most profitable part of the business. And so that will be a bridge to full self-driving, which we think is much more likely to be fast-tracked under a Trump administration. And also cyber cab and just the AI, the sheer breadth of the AI usage of this company. I think you really want to own this stock for the long term. So whenever it gets volatile, we always step in and add to holdings. But we do take money off the table when it rises because that it is volatile, and so you want to trim back. Right. So it's been a great stock for us. I went to the Cybercab event that was in LA. Yeah,
right.
It was long on cool, Justin. It was a little short on details. The stock sold off afterwards, member, and Uber went way up, which is also a member of our 12 Best Ideas portfolio. But what I discovered two things. That the innovation continues and that the devotees don't really care about the details. Those are the individual shareholders. And I found my home healthcare solution in Optimus, the robot.
Okay, perfect. Okay, so you're, I wasn't sure if it was going to be home healthcare or bartending, with the Optimus.
Either, both, really.
Well, and it's funny, and I should have mentioned at the outset that I do have a position in Tesla myself. But some of these bases here, I mean, this was a 30% correction here, and then you had like a 50% correction here. So I guess again, when you mentioned that some of this was that you were selling into strength, but is there another element that's like, oh, okay, we got to batten down the hatches to a degree, and what are you using as kind of those sell signals to
this was
manage
a stock
the position that you might be holding for a longer term, but to make sure that you don't take your portfolio down with it.
Right. So Tesla is not in our 12 Best Ideas portfolio, not because it's not a great idea, but because it is exceptionally volatile. Yeah. And it is a stock that investors love to hate. And so what we do is we just are very disciplined. We set a target for the name. And when it rises to 50% above that, we will trim it back. So we were selling, trimming, not selling, many of our tech holdings in early July of last year. And we just got lucky. And then when they sold off through the end of the summer, we added back to some of the names. Tesla was one of those. And so we will continue to do that at the margin. But once we decide, as we ultimately did with Apple, that it was just too expensive, we went from trimming to selling, and then put it in left it at the minimum position in our portfolio, which is 2 to 2.5%.
And so I caught that you said targets. How are you setting those targets? Is it based on fundamentals? Is it based on forward-looking PEs? What helps you set those levels of, okay, this is where we need to start taking some of our profits off the table? Yeah.
So back to the 12 factors. The catalyst for outperformance is critically important to us. And so we spend a lot of time. I sent you a 12 factor on CrowdStrike. The analysts had about 5 catalysts for outperformance.
Yeah, right.
And the same for Tesla. And for us, it was the energy business, so the Megapack business, the full self-driving and autonomous vehicles business. And on top of that, the second most, or equally as important, I should say, is the analysis that we do on management. So it was clear to me that Pat Gelsinger was not up to the job of saving Intel. So we got out a number of years ago. Same with Karen Lynch, I think her name was, I've already forgotten, at CVS. The model wasn't good. They paid down debt, then they accumulated a ton of debt, and we just thought that the business model was broken, and so we got out. So it's fundamentally driven, but it's really heavy on what's the catalyst and what's the management team like. And so I'll talk about that again when we talk about my stock picks at the end.
Very good. And before we kind of end this part, I wanted to also bring up Adobe as an example of, okay, you need to know when to not overstay your welcome,
Yeah.
or recognize a hint when something is telling you, okay, this is not working. So
Yeah.
what was the deal with Adobe?
I think management has disappointed too many times in the last year. And so, yeah, they're going through a transition. We get that. The AI, the Firefly business, and the adoption of generative AI in their installed base is great, and they are the industry leader, but they're not monetizing it. And I think we still own it in our growth portfolio. We just didn't think it was any longer a best idea.
Hmm.
We will give management time, unlike Wall Street, um, but we won't wait around forever. And it just seems like they've come a little bit tin-earish about earnings, and I think they need to. I imagine next report they'll blast it off. But it's been a disappointment, and so we thought there were better places to be, and we added in a name I'm going to talk about later.
Okay, well, you know what? Why make the people wait? Let's go ahead and get into some of those of your ideas. Some of your 12 best ideas names. Where do you want to start?
I think I want to start with Spotify, which is what we used to replace um, Adobe.
Okay. And I do have a position in Spotify myself. Yeah, this is one in terms of a few of the things that we look at here at IBD. This blue dot is kind of telling you about relative performance versus the S&P 500 as seen by this line here. And a blue dot is when something's in a base and has that relative strength line near new highs. So on the price side, this definitely has that relative performance to the S&P 500. But tell me what you're seeing.
Yeah, so we've owned it. We sold Meta along, I don't know, a number of years back and bought Spotify, and it was a good trade actually, even though it would have been great if we held both. But we really wanted to own this name because we thought that the management team was responsive and nimble to the market and to investors. We knew that last year was the year of monetization, so they started delivering earnings and they added price increases, which drove earnings. And now they're set in a position. Oh, and then they opened up like Joe Rogan onto other platforms, which increases advertising revenue and doesn't really give up much in terms of exclusivity. And so that, I think that was a very wise move. And then, the earnings growth is going to be 58% in 2025, 28% in 2026. So on a PEG ratio basis, and it's trading at just slightly above one. So price earnings to growth rate, that's a very reasonable valuation. And we think that the growth continues, and then add in the fact that it's recession proof. And you saw Netflix recent earnings report, subscribers are subscribing, and that's what we've seen from Spotify. So it's a member of our 5 for 25 list and a member of our 12 best ideas portfolio.
So you mentioned the earnings. So certainly one of the things that sticks out is that this has not been profitable, really until I'm going to scroll down here. I lost my cursor. Okay, there we go. So yeah, you can see as you mentioned, just recently kind of got into the profitable zone. So is the sales has the sales been strong enough to kind of say, okay, it's okay for the earnings not to be there yet?
Yeah, absolutely, and that's why we look at relative price to sales, because sometimes you want to own companies that are in strong growth mode even before they deliver earnings, if you think they're on track. And I think that's what Daniel Ek did very well. He managed expectations. They reinvested in the business for many years, and then they understood, just like Tesla did, that it was time to put earnings on the board. And so they did that, and they're continuing to grow. Margins have improved. So it's a great company, and it's a staple in many households, funny enough.
Right.
And so I think we believed that it was in a much stronger position than Adobe was.
You mentioned staples in a household, so I'm gonna just lead into Amazon with that, because one of the staples in my household is those boxes that just pile up outside my door. Tell me what you're seeing with Amazon, and I do have a position in this myself as well. I swear I didn't go out and buy your portfolio before you came on. It just so happened that we intersected on a number of stocks here. But yeah, tell me what you're looking at here with Amazon.
Yeah, so gave an interview to the Wall Street Journal at one point or early in the decade, and this was our stock pick for the decade, and I think it will continue to deliver very nicely for investors. When Andy Jassy took over, he got Tim cooked. So he was underestimated, he was dismissed, and the stock sort of struggled for quite some time. Then the company, delivered on what they said they were going to deliver on. Cloud growth is still a critical portion, AWS, a critical portion of the business, but their advertising revenues are growing. They've streamlined retail and delivery, and it's a company that can continue to thrive as they've grown the media aspect of the business, and yet, unlike Disney, which has a hard time, trading at the sum of the parts, or in excess of the sum of the parts, that Amazon does and can. And so if you look at earnings growth there, they're expected to grow 21% in 25, 22% in 2026. The PEG is well under 2. And remember, they're still kicking off $50 to $60 billion in free cash flow after record CapEx budgets of around $50 billion. So we think this name, can continue to deliver and outperform. They have a pristine balance sheet, and they have a management team that is really delivering on every metric.
Yeah. I don't want to open up the can of worms, but one of the things I did notice when I was reading some of your reports that you shared with me is that free cash flow was a big thing. That you were definitely keying on that on a number of metrics. And when you were looking at management and catalysts and everything, that free cash flow, definitely was something that stuck out to me as being important to you.
Yeah, and it's one of the quantitative factors that we pay very close attention to.
Yeah,
it is important for so many reasons, and I'm sure every investor pays attention, but it is important because it takes out CapEx. I mean, free cash flow is after CapEx. And so that's, when you hear all these companies are spending too much money, I don't know if you can kick off $50 billion annually. I'm just waiting for Amazon to declare dividend, but I've been waiting. I've been talking about it for 3 years, and so far they haven't taken the hint.
Yeah.
But yeah. And then I'll just say one last thing about this, Justin. So, for your viewers and for all retail investors, when a stock is up, sometimes it's hard, to say, do I want to buy it here? And so I just went back and looked at Amazon since the IPO in May of 1997, and my numbers are a few weeks old, but the stock is up somewhere around 275,000%. So if you're buying a company that has great strategic vision, market dominance, all the things that we talk about in the 12 factors, you can. When was it too late to buy Amazon?
Yeah, right. Well, and I guess there's two sides to that, because a lot of people would say, well, gosh, if you thought it was too expensive up here, shame on you, or too expensive up here, or too expensive up here. But, then other people might say, well, eventually, won't it be too late? I mean, it's gone up so much. How much more can you expect? And the law of large numbers, right? With a lot of these companies, now granted, they hit 1 trillion and it felt like 2 trillion happened so quick after that with a lot of these companies. So how do you kind of, quell investors' fears that they're going to be the ones that are late to the party and they end up cleaning up?
Well, we all still have scars from 2000, but this is a very different technology and a very different consumer of the technology. So if you think back to the 90s, you had companies that were being valued on eyeballs, internet companies.
Yeah.
And then the internet companies, many of them failed, e-toys, e-pets, all of that. And then that hurt the infrastructure providers like Cisco, which was trading at 100 times peak earnings. So you have to be aware of your environment. And there have been periods, long periods, or seemingly long periods where Amazon has underperformed. But it really is a way to provide you with an opportunity to get in. And to draw the equivalency further, I would say, remember, Walmart was the great growth stock in the 80s, and it became a value stock. And then now it's back to growth status. And so if you're buying great companies that you can own for a lifetime, Doug McMillon was the secret sauce at Walmart. Satya Nadella was the secret sauce at Microsoft. So you have to keep all of that in mind as you're looking and thinking about how long can I own these companies, and are they really names that I can own for a lifetime? And those are the kind of companies we're trying to buy, because turnover is expensive from a capital gains tax standpoint. So to the extent that we can buy great companies that we can hold for very long periods of time, and oh, by the way, if they are paying a growing dividend, I'm getting paid to wait, that's even better. And so those are the things that we think about and look at. But, Intel was once a great growth company. And it had deteriorated, and we thought, the previous CEO didn't do the firm any favors. He had been the CFO, and when they brought Gelsinger in, he got the benefit of the doubt from us too, until he didn't.
Yeah.
And instead of turning the company around, he went hat in hand to DC, and for us, that was the exit point.
Well, and it sounds like, again, with all these companies that you're talking about, Amazon, Walmart, there is not an element of complete reinvention, but certainly a somewhat reinvention where, again, Amazon started as a bookseller, and now AWS accounts for such a huge portion of their revenue.
Right.
Microsoft, yes, it was an operating system, and then it didn't do anything for 15 years
Right.
until cloud computing came about. So there is
As
that
CEO.
reinvention.
Yeah,
Right.
you're
Yes.
100% right. And so the pivoting becomes critical because, don't forget who developed the mouse? Xerox.
Right.
Who monetized the mouse? Microsoft, Dell. So you need the management teams that are pivoting at the right time. And, that's a subjective judgment, which is why we call it a qualitative factor. But any investor can, if they're paying attention, can draw a pretty complete assessment of management. And that's how you make money.
Yeah. And I feel like with some of these stocks that you've talked about just now, Walmart, Amazon, Tesla to a degree, and again, I do have positions in Amazon and Tesla, and Spotify, Spotify also in there. I think it's easy to understand that on a consumer basis, but let's go ahead and shift gears to ServiceNow,
Yeah.
because this is one that might be a little bit more difficult for people to kind of, if you're not using ServiceNow, how do you know what those catalysts are and how well it's doing?
Yeah, and they are led by one of the, I said this on a Bloomberg interview, and he sent me an email, the best CEOs in the country, I think. He's also a great salesman, and that's Bill McDermott. And so what you want to pay attention to, this is a company that has delivered low to mid 20% earnings growth every quarter for the last 3 or 4 years. So even during the bear market of 2022, they continued to deliver growth in the 20% range and above, and they weren't being rewarded for it. And so what you have to think about who's going to benefit from generative AI computing, and ServiceNow is kind of the conductor, the traffic manager on the cloud, and utilizing the data to enhance their customers' experience. And so, what really keyed in for me is there was a CIO survey, and I'm going to read the numbers because I get up at 4 a.m, so it's almost bedtime for me. Okay. But 71% of CIOs believe that AI will be very productivity enhancing. This is a Bernstein CIO report. 80% said they were exploring potential applications of large language models, but only 8% said that they were going that it was in their budget for this year. That's mind blowing. And McDermott came out in an interview and said he believes that spending on generative AI and generative AI cloud is going to be $20 trillion by 2030. So he only has to be half right. And that's going to be a compelling metric. But then again, if you look at the PEG, and I don't know if I had that in my write-up, but it's expensive on a multiple basis, but it's not terribly expensive on a PEG ratio basis. I think it's around 2 times. And so, if you've got a stock, Tesla's trading at 4.5 times, or it was the last time I looked, on a PEG ratio. That's kind of lofty, but
Yeah.
that's a story stock. And ServiceNow is an earnings growth stock. And the CEO has said, and I quote, "We are perfectly positioned for the convergence," and he's talking about AI and generative AI cloud computing, and that we're seeing with cloud computing, AI, and workflow automation. And so you're constantly hearing companies that are implementing workflow automation. We just signed up for a software that it's AI driven, that combs all the financial sites, yours included, and will give you insight into earnings. What were the summaries? You can say how many times was, all the stuff that you need, and it can replace, in our firm, it'll replace an analyst.
Yeah, yeah. And to your point here, as you said, this is an earnings grower, EPS growth rate of 32%, that we show right here on our metrics. And
Okay.
we have this earning stability factor. So the lower the number, it goes from 1 to 99. The lower the number, the more stable. So this kind of tells you a 4, this is very stable. So you have a high earnings growth that's very stable. That does tend to be something you see in a lot of these long-term leaders.
That's awesome.
Yeah, but now I noticed here, Nancy, that man, the yield was none on all of your ideas. So I want to make, because someone on our YouTube live YouTube channel, Tim, who I've met personally, he was saying, like, why all this focus on dividends? So it's just one factor though for you, right? And
it is. Well, we
yeah.
have a strategy where you must own a dividend, you must pay a dividend. And then we have a growth strategy, as I mentioned earlier.
Yeah.
So in the growth strategy, I don't really care if they pay a dividend, because I'm buying stable earnings growth. I love that metric. And that's what you want to own if you think the economy's slowing, or just that you think that we're going to be in a kind of a moderated GDP environment. But the dividend, I mean, Microsoft pays a dividend, Google pays a dividend now, Apple pays a dividend, and then other names that we own in that portfolio would be names like Carrier and Emerson Electric, and trying to think of, isn't it funny? Like, I do this every day, and I can't. Starbucks, which you'll probably get emails about, McDonald's, and so we want to have exposure. Goldman is our one of our 12 best ideas, and one of our 5 for 25. They not only pay a dividend, but they grow it pretty handily. And then Walmart, as I mentioned, and a whole host of chip names. The name I've been talking about the most over the last 5 years is Broadcom. Which at one time was, trading at 3.5%. We call it the poor man's Nvidia, and the yield was close to 4. Capital allocation plan is amazing, and we bought that name in 2018 when they did the Computer Associates transaction, and it's been a monster workhorse, and they've continued to grow the dividend around 12% on a trailing 5-year basis. So we do care about dividends. But in our growth portfolio, we don't care so much about dividends.
Yeah. Well, Nancy, this has been very informative. I really appreciate you coming on the show. And again, I think you hit it out of the park in terms of a first-time guest. So really appreciate all your insights.
Thank you so much for having me, Justin, and sharing those charts with me.
Absolutely. And you know what? I also want to just, what's the best way for people to get more information? I see that you have behind you, an ETF, but what is the best way for people to get more information on you? Follow you on Twitter?
Yeah, at Tengler, and I'm posting more. And then in terms of, I do have LinkedIn, but I don't remember. It's just Nancy Tengler. And then we have a website, www.laffertengler.com, and our dividend growth ETF, TGLR, owns many of those names, plus Oracle, which is among the largest holdings that pay dividends. So that's the only publicly traded fund, but give us a call.
Wonderful.
Sign up for our work. We publish quite frequently.
Awesome. Well, again, thank you for coming on the show, Nancy. It was great meeting you.
Thank you. You too, Justin. It was a lot of fun. Thank you.
Okay. That's going to wrap it up for us this week, but I hope you join us for next week because we've got Matt Caruso coming back on the show. Matt is, of course, one of my favorites, only because the first time I did this on my own, Matt was the one, was my guest, and so he holds a special part in my heart for doing that and being such an easy guest for me. And it's almost like we've got we had David Cox on last week, Matt Caruso this week. It's like we're doing Canada in January. So hope you join us for that. It's going to be a lot of fun, as always, with Matt. And that wraps it up for us this week. We'll see you next time. Bye now.